Stop what you're doing right now. If you own any regional bank stocks, you absolutely need to see this 5-model valuation breakdown. Look, while the financial headlines are out there constantly screaming about crumbling commercial real estate and, the next impending bank failure, there is one under-the-radar stock down in the Southeast that is quietly building an absolute financial fortress. It's basically a financial bunker in the middle of a storm. Last week, I ran FB Financial Corporation, ticker FBK, through 5 brutal valuation models, plus the legendary investing checklists of both Warren Buffett and Peter Lynch. And honestly, what I found completely shocked me. Now, if you've been watching the banking sector lately, retail investors are absolutely terrified right now of hidden bad loans just wiping out their entire portfolios overnight. And hey, it's a completely valid fear. But then you stumble across a staggering statistic, like 25.2%. According to my blended valuation models and Wall Street's median target, this stock's intrinsic value could be over 25% higher than its current trading price. Think about that for a second. In a macroeconomic environment where most banks are, frankly, just trying to survive the week, projecting a massive jump like this is incredibly contrarian. So I just have to ask, is the broader market severely mispricing FBK, or is this just a classic value trap just waiting to spring on us? So does FB Financial's Q1 2026 performance actually justify all this massive hype? Well, by the end of this explainer, you'll know exactly if FKTA is a definitive Buffett buy or a total Lynch value trap. We are going to rip apart the raw earnings, we'll dissect the recent aggressive acquisitions, and we are going to mercilessly stress test those protective buffers that management claims to have built up. I'm going to give you a clear, actionable framework that you can literally steal for your own fundamental analysis moving forward. Here is our agenda for today. First, the Wall Street consensus. Second, a Q1 2026 earnings breakdown. Third, the Southern States merger. Fourth, balance sheet and safety. And finally, number 5, rewarding the shareholders. Let's dive in.
Section 1. The Wall Street consensus.
Out of all the analysts covering FBK that are tracked by TickerNerd, there are 7 consensus buys and absolutely 0 holds or sells. 0. That is a remarkably unified stance. We're talking about major firms here, like Piper Sandler, Cantor Fitzgerald, and Keefe, Brewett, and Woods, all consistently reiterating overweight or outperform ratings throughout the early months of 2026. This level of total agreement really implies that these institutional watchers see a very clear, heavily de-risked path to growth for the bank.
Section 2. Q1 2026 Earnings Breakdown.
Now, ratings are great, but the actual cash generation really backs up Wall Street's optimism here. Check out this dramatic year-over-year growth. Net income jumped from $39.3 million back in Q1 of 2025 to over $57.5 million in Q1 of 2026. And following right along with that, diluted earnings per share, that key metric of profit divided by all possible outstanding shares, surged from 84 cents to $1.10. Guys, generating an extra $18 million in quarterly net income in a single year, that demonstrates a serious expansion of their earnings engine.
Diving just a bit deeper into the numbers, we can see their core banking operations are highly efficient. Even with a pretty challenging environment and recent interest rate cuts, FBK defended its profitability. They maintained a very healthy 3.94% net interest margin. Simply put, they're still making a really strong profit on the spread, the difference between what they pay out in deposit interest and what they charge out for loans. And that healthy margin allowed them to pull in a whopping $146.8 million in net interest income.
Section 3. The Southern States merger.
So what exactly was the primary rocket fuel for this recent surge in growth? Well, it was the strategic acquisition of Southern States Bank shares. This merger officially closed on July 1st, 2025, and by the third quarter, FBK had already fully converted the operational systems and taken the necessary initial accounting provisions of about $28 million. Because they managed to integrate this whole acquisition so swiftly and so cleanly, total assets reached an incredibly impressive $16.5 billion by Q1 of 2026.
To really put that massive number into perspective, this single move rapidly expanded their footprint into Alabama and Georgia, adding 13 new branches to their network. But crucially, it injected $2.4 billion of deposits straight onto FBK's balance sheet. Deposits are essentially the vital inventory that banks need to operate and lend out. And speaking of lending, it also brought in $2.2 billion in new loans. So this wasn't just a geographical expansion, right? It was a massive volume injection.
Section 4. Balance sheet and safety. Now, rapid growth can be risky, so we absolutely must check the safety metrics. But credit quality here remains remarkably stable, even after absorbing that entire Southern States portfolio. They've built an allowance for credit losses, which is basically just a giant rainy day fund for bad debt, that's sitting at $186.3 million, or roughly 1.49% of their total loans. Furthermore, their non-performing assets are safely under 1%. And honestly, perhaps most importantly, despite all the terrifying headlines you see about commercial real estate right now, FBK only has about a 4% exposure to the commercial office space.
And this brilliantly illustrates their margin of safety against strict regulatory requirements. It is incredibly robust. Their total risk-based capital ratio is at 13.4%, floating very comfortably above the 10.5% minimum requirement. Meanwhile, their Tier 1 capital is at 11.5%, again easily clearing the 8.5% hurdle. Basically, they are holding a thick buffer of capital against potential economic shocks, making absolutely sure they can absorb unexpected losses without putting the franchise in any sort of jeopardy.
Section 5. Rewarding the shareholders.
Let's move to the final piece of the puzzle, how this all translates to direct rewards for the people actually holding the stock. FBK recently declared a 21-cent quarterly dividend per share, but what is truly remarkable about that is it marks an incredible 33 consecutive quarters of dividend payments. Think about everything that has happened in the market. Through rate hikes, rate cuts, economic turbulence, and a major merger, management has prioritized a consistent, reliable return of capital directly into the shareholders' pockets.
And get this, they aren't just stopping at dividends. Management just authorized a brand new $175 million stock repurchase program, which runs all the way through June 2027. You know, when a bank uses its excess capital to buy back its own stock, it signals immense confidence in its own intrinsic value. By reducing the number of outstanding shares, they are functionally increasing the ownership stake and the future earnings per share for literally every single investor who holds onto the stock.
We've seen the surging net income, the highly accretive impact of the Southern States merger, the strict safety protocols, and a management team that's entirely dedicated to stock buybacks. Based on the Buffett and Lynch frameworks we discussed earlier, this bank checks almost every single box for a high-quality, undervalued compounder. So, I will leave you to ponder this as we wrap up. With a Wall Street consensus projecting a 25% upside, expanding footprints, and solid safety margins, is the wider market severely underestimating what FB Financial is building down in the Southeast? Thank you so much for joining me for this explainer, and keep learning.